Hello, my friends. It's Hammer. Today is Thursday, June 12th, 2025. I, of course, am the Rate Sensei here to give you your mortgage rate update for today, Thursday, June 12th, 2025. Today, we're going to talk about wholesale inflation. The producer price index PPI readings came in this morning. We're going to go into a little bit of detail on those, what they mean, why they mattered, how they're helping rate sheets this morning. We're going to talk about the trade war stuff, a little bit about China, some interesting insight from an article I read this morning on Bloomberg. We're going to hit the cracks in the labor market. We're not going to go too deep on that one, but it's important that we recognize that the labor market is a huge component in what the Fed is going to do, and that after last week's big headline numbers, there are a lot of cracks in the labor market and why that's going to help mortgage rates. We're going to talk about that. We're also going to talk about why the outlook is shifting in favor of lower rates for the moment. Now, remember, it's always an ebb and a flow. But for right now, things are looking good for mortgage rates. I'm going to tell you what's going on there. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. If you're here this morning, say good morning. If you are watching on the replay, don't forget, give me a hashtag replay in the comments. I've noticed the replays are down. So if you are watching but not giving me that hashtag replay, please do. It does matter. I do take a look at those. If you're here live or on the replay, don't forget on Facebook to smash that like button, tag an LO friend in the comments. Seriously, I really do want to get this thing. We had about 55 live people on yesterday at one time. I'd like to get this thing over 100 people a day. If y'all want me to keep doing it, you got to help me grow. I got to get serious about it, and so do you. So go ahead and tag an LO friend. Share this post in a group is always appreciated. If you're on Facebook, you can go ahead and share it into one of the mortgage specific groups. If you're on YouTube, don't forget to subscribe, thumbs up, all that good stuff. Also, comment. Your engagement helps us grow because it tells the algorithm that people are interested. So the more that you comment, like my man Ron Siegel and Mike Morano and Robert Bashirs and so many of y'all, it does matter. So plus, I want to hear from you. I want to know what you guys are thinking. Remember that if you would like a reminder that I'm going live, you can get one at hmmr.io/reminder, or you can also use this cool QR code over here. It's down here somewhere. Here it is. If you're on your phone right now, you can take a screenshot, go back to your photos, and that will work. All right. So I've said so many things. Again, welcome to all of the live folks. Appreciate all of you that are here this morning. Let's go ahead and get started, get into the good stuff. What do we got going on this morning? Let me go ahead and share the screens and we will start going over it. So quick recap, what happened yesterday. Let's zoom in on the 48-hour chart down here. So yesterday you could see, no, I don't want to enable dictation. Yesterday you could see that we started out lower. See, oh, you can't see anything because, hold on a minute. Let me move this above. Hold on. No, come on. There we go. Okay. All right, let's do that. There we go. Now you can see. All right. So over here, you can see that yesterday we actually started the day lower. If we look at the 5-day, you can get a much better view on that. Right here, you can see that we actually ended the day before, which was Tuesday, and on Wednesday we started the day lower. However, after that, let's go back to the 2-day, and you could see there was a significant uptick here after we got the CPI data. Once again, why was that such a big deal? Why was that CPI data so important? It was because it showed that inflation from tariffs was not hitting as hard as was expected. This report was the one where markets were really expecting it to see tariff inflation starting to take effect. Now, bonds improved yesterday, and they did hold the gains for the day. If we take a peek here, you can see that as pricing came out, we were around 98.95. We actually ended the day a little bit better than that. This is a slight improvement. When mortgage bonds go up, that's good for your rates and pricing. When they drop down, that's bad. So seeing this move up was good for rates and pricing. There were a small handful of lenders that did reprice better late in the day yesterday. it wasn't because of the improvement that we saw here. That wasn't really as big of a deal as it wasn't really a big deal is the bottom line. The reason that we did see some lenders that repriced better was mainly because they were probably holding back and priced conservatively when we saw the gains. And remember, yesterday, what we were looking at after that CPI data right here was this candlestick and this red line. We were testing the 50-day moving average, and that 50-day moving average has proven recently to be a strong technical resistance level. So there we go. So Mike Thibault, Ron Siegel made a great point. It's only 6:30 in California. Maybe start later. Not going to happen. This is when things roll out on the East Coast. This is when lenders start setting pricing around 10 a.m. Eastern time. This is when the market gets moving. You can always watch the replay for those that are on the West Coast, and I know that many do. So, anyway, I know what you're saying because you guys are responding to me wanting to get more people on. So I get it, and I appreciate that. Let's keep going. Rate sheets today should match last week's best levels from Wednesday and Thursday. So a few things to look at. Right now, you can see this candlestick right here. This was last Wednesday. Remember, when we see green and it goes higher, when this moves higher, that helps your rate sheets, that improves things. This green candlestick, the day before we were down here, the next day we ended up here. That is a jump in mortgage-backed security pricing. That is something great. What that leads to on rate sheets looks something like this. Last Wednesday was the June 4th, and you saw that we went from 6.96 the day before to 6.87 on rate sheets. And because of that, that is a bit of a big deal. I'm going to bounce this in so we get this on the side to side here. All right. So that was a very nice deal. And it faded on Thursday. We saw some loss, but then on Friday, it went right back. We saw that whole thing disappear. And it's kind of important to make a note of this for now. I'm going to circle back on that. But we were at 6.96. And then 2 days later, we were at 6.97, right? So if we take a look at what's going on mortgage-backed securities, this was that level on Wednesday, and Thursday morning rate sheets came out. They were fine, but then they lost ground through the day on Thursday, and we lost ground on Friday because of that labor market data, right? So now if we take a look at what's happened yesterday, this candlestick right here basically brought us right back up to labor market data, which that's why I always tell you on Fridays, even if we do get a report that was kind of not all that great, it's not going to last long. Generally I'm looking for that to disappear, and it only took 3 days. Here we are on Wednesday and it disappeared. Especially it was helped because of the CPI data. So, I don't want to put it in a bubble. You do have to recognize that there was a reason we saw that. But one report brought us down because the headline number came in so much. It was higher than expected. Not really so much. It wasn't a super strong report, but it wasn't showing enough labor market weakness for markets' tastes. However, the CPI data coming in so much better basically just washes all that out. Now, today, look at where we're at. And once again, I want to point out to you, Wednesday, we were here. We are actually better than we were on Wednesday. All right. Now, yesterday, I was in a bit of a locking status. Yesterday, my concern was that we were testing this moving average. And if we go ahead and make this a little bit smaller, I'll make this smaller so we can get more of it on the screen. If we take a look here, this 50-day moving average has been a big deal going back for months. We break above it, we almost immediately fall back below. Over here, we spent a couple of days above it, but then we were also right back below. Why does it keep moving the side of my face? I'm right here, camera, right here. So anyway, looking at this was a big deal to me, this 50-day moving average. Now, my concerns, you can't totally wash them away, but look at the gap that's here and the jump that we've got going on here. And there was a bond rollover in here somewhere, and even that, not enough to derail this, right? But taking a look here, if we go ahead and zoom in on this for a minute, and I want to show you. See the candlestick? Remember what the body and the wick mean. The wick is the point right here. This is the point that was the best level for mortgage bonds. Right here is where we started the day. Right here is where we ended the day. It's a green candlestick. It improved. It went up on the day. So we ended the day. The body right here was still right at that 50-day moving average. So it was very concerning. And the fact that we have blown through not only this red line, but also this green line, the 100-day moving average, to open today, and it's improving. That's awesome. Now, reprice risk on the day is low. Normally, I would be concerned that we would get more of a drop here. But last Wednesday, there wasn't really a reason to see this big jump. It really caught me off guard. If you remember, I was like, there's really no reason to see bonds move except for maybe positioning ahead of the jobs data. And I mean, we did see a weak ADP. Maybe it was an overreaction to the ADP payroll data. I don't know, but it wasn't really foundationally secure to see this improvement. However, this improvement that we've seen here, this jump, and it's because of inflation. Remember, inflation is the big concern. So reprice risk on the day is low. We are going to get the 30-year Treasury auction at 1 p.m. this afternoon. Earlier in the week, I talked about how markets are looking at long-term bonds, and that auction was getting a little more scrutiny than usual. But what's going to happen, what's likely to happen, I can't tell you what will happen, but what's likely to happen is because of the improvements that we've seen, because of the inflation data, wholesale inflation, by the way, this is funny. I love watching the headlines when it comes to this stuff, right? U.S. wholesale inflation heated up in May. It did, but this is CNN, right? This is pulled from CNN. U.S. wholesale inflation heated up in May. It was higher than the month before. The month before, it actually came in negative, minus 0.2. And this, when it was 0.1, it was positive 0.1. But I think a more accurate interpretation is what you saw here at MarketWatch, which is more good inflation news. Wholesalers show little sign of rising prices from tariffs. And, you got to give Ron kudos, because Ron talked about how he didn't think the tariffs were going to have much of an effect. And that has so far been a lot of the case. Now, again, this is when kind of the first reading that we expect to see the tariffs hitting consumer prices. And it has hit some consumer prices, but it's not hit them enough across the board overwhelmingly to see inflation as a whole moving. So producer price index barely rises in May. Trade wars haven't led to more inflation so far. Again, it's just a headline. There's more in the actual article, but the producer price index, the headline was 0.1% in May. The core also 1% last month, which was below forecast. And that's part of why we're getting an improvement this morning. So our takeaway for all this, the outlook right now for rates is good, but there's a definite floor. We're not likely to see rates move all the way back to September's levels. If I got to put this on 6 months so we can get all the way up here. I mean, you look at where we were at a high for September. That should be, yep, it is. It's right here. So let me make this full screen so you guys can get a better picture of this. And let me get my head out of the way. Hold on a second. All right, so take a look. This is where we were in September at the best levels. There was this day where we started out really high and it dropped. Let's just go ahead and call it right here. Let's leave that day out of it. But so September, we were around 100.50, 100.40. It looks like, what was this actually? 100.40. So we were at 100.40 for the 5.5 coupon. Right now, we were at 99.23. So we would need to improve another 120 basis points to match September's levels, which, if you remember, that was when rates were in the low sixes. Right now, though, we have our best outlook for rates that we've had in a while. After seeing rates, and let me bounce this back to screen so you guys can see it. Sorry, y'all. It's a pain in the neck, but I got to move this each time when I'm playing around with this. So taking a look here and looking at these numbers, we've seen them all in the high sixes here. and we could see them go down maybe into 6 5/8, 6.5 even, depending on what happens at next week's Fed meeting. So, and more so than the meeting, it's going to be Powell's press conference. Next week's press conference with Powell could help push rates a bit lower. Right now, there's little risk that rates will move higher than we saw in May. Now, I'm going to throw my email up on the screen for a minute. I want to show you guys. Let me see if I can pop this out. I don't know how to pop this out on Superhuman. I went back to Superhuman for my email. Let me pull Gmail because I can do it there, and we'll go into that for a minute. So, all right, how do I pop this out in Gmail? Where's that little? There it is. Okay. So take a look here. I wanted to show y'all, you may want to make sure if you're not signed up for the daily lock advice emails, make sure you do sign up for those. Not only do I give you an amazing quote every day, there's the advice at a glance. The advice at a glance right now is cautiously float anything closing near term. Let me throw this up on the bottom for y'all, by the way. Cautiously float loans closing in June, less than 15 days, but float the rest. And with expectations that we could see rates creep lower. So yesterday we were in a locking stance because of this, now in a cautiously floating stance for near-term loans and floating everything else. And I've kind of tweaked my format here for the rate outlook over the next 15 days, 30 days, and longer term so that, you can get an idea. Float these loans. There's a minimal risk for them at the moment. Float these loans with an eye on next week's Fed meeting. Cautiously float and start forming a plan about next week's Fed meeting. Beware of an unexpected reversal today or tomorrow. And then I kind of give you a little bit more insight into that. So if you want to go deeper on some stuff or have something quick, go ahead and make sure you signed up for the free daily lock advice emails, and those being what they are. So the lock advice is down at the bottom. Last thing I want to give you, the Fed outlook right now. Nobody is expecting a rate cut to happen at the, let's put this to current. Let's move this over. Come on, Rover. We need you to move over. Let me put this here. Slide this over here. There we go. Okay. Let me slide the bottom up so you guys can see that a little bit better. Put this right about there. All right. So right now, going back to June, let me make this a little smaller so it fits better. So looking at, at the June meeting, which is next week, next Wednesday is the conclusion of the Fed meeting, and we will get Fed Chair Jerome Powell's press conference. Right now, you're looking at no expectation at all that we're going to see a Fed rate cut to happen next week. Not even really one in July. There's about a 25% expectation, which is more than we've seen in a long time if we compare. It's not as high as it was a month ago. That's right here. A week ago, it was here. It dropped back down a day ago, but now it's starting to creep up. But overall, market's really not looking to see much of a change for July. Right now, the big expectation is September. And even, a month ago, markets were looking for at least 2 rate cuts by September. That has eased down to 1. And this is a 60% probability. So if we see this increase next week where, after the Fed meeting and after Fed Chair Jerome Powell's press conference, if markets start to think that there's an 80 or an 85% chance that we see, a rate cut in September, that would be huge. It's more likely we get at least some kind of improvement, once again, depending on if the Fed is dovish in their comments. So we'll see where that brings. Let's go ahead and go over your comments, and then I'm going to wrap it up for today. I've got to go and pick up the kitties. They were taken for getting fixed. So your comments, Ron said, it's early. I still think it's a great timing because otherwise, even on the West Coast, you don't know what's going on for the day. The services wait for all the data to come in. By that time, it's too late. Yeah, I agree. Thanks, man. Y'all definitely have a good point. Robert said, I'm thinking I shouldn't drive my Jeep topless in Florida rainstorms. No, you shouldn't. However, the great thing is you can pull the plugs. I spilled diesel in my new 2025 Jeep. It was 3-4 months old. And, oh boy, was that terrible to clean. I had to pull everything out of it. So anyway, if y'all have anything else to say, appreciate you. Robert said, lock before Powell speaks. No, I wouldn't. We'll talk more about that as we head into next week's meeting. But no, the door is open right now for things to improve. So everyone bags on Powell. Again, I don't think he's getting the credit he deserves for navigating the Fed through the pandemic and the economy being where it is and different things. So anyway, Sean said fixed. Oh yeah, they all get fixed, dude. That's one of the big things about the cat sanctuary my wife works at is they all get spayed and neutered. So kind of like Bob Barker used to say, spay and neuter your pets. He used to say after every Price is Right, at the end of every Price is Right episode. Siegel pointed out it'll be interesting to see what Nick Timoros's comments are on Sunday or Monday. Yep, the Fed whisper that will maybe give us some insight. We'll talk more about that next week as well. All right, y'all, appreciate you. Siegel, you're funny. Even Powell's wife doesn't recommend him as much as I do. That's right. I am a Powell fanboy. I think the dude, especially for an attorney, I think the dude has done a great job. So, all right, y'all. Well, thank you for joining me. Hope today's show was insightful for you. Don't forget to check out our other products to help you grow your business. You can check out Originator Success, which will help you to build your online brand reputation. AI search becoming a thing. We are on top of it. Y'all know I hate AI, but it is a thing. We are on top of it. New websites coming out soon. I know I've been saying that for forever. Check us out, originatorssuccess.com. Also, Grab and Go Social. The pre-sale is going to wrap up soon. We're going to roll it out at its regular price. Get early access, $7. Go find out what it's about. If you need help building your social media presence, you need content to post, you can grab and go. Every day we've got brand new fresh content. We've also got a lot of strategies and coaching to go with it at a price that is unbeatable. I know many originators out there need help getting out there, so go check that out. All right, everybody, I'll see you guys tomorrow.